or forex market is what we think is the only that this reporters and of this category like your how we have currency similar today we have a at Axis Bank and managing multiple corporate treasuries. Mr. Saurabh has gained an expertise in forex and interest rate products and derivatives. Mr. Saurabh is also a certified independent director on the board of several companies. We welcome you, sir. So, before beginning with the session, I would request my audience, both on YouTube as well as Zoom, to put on their questions in the chat box. We'll take them one by one. Sir, now I would request you to start the session and guide our audience about the forex trading. Over to you, sir.
Thank you. Good evening, everybody. Welcome to the session of Demystifying Forex Trading. Actually, when we say demystifying, it really brings in an aura that it is some rocket science that we're going to talk about. Frankly, it is not. And hopefully, after this session, you will agree that what I just said is true. So, let me just share my screen with you to begin with so we're going to talk about demystifying the forex trading, and we're going to specifically concentrate on the currency futures and options. And within the futures and options market, we're going to focus mainly on the currencies which we can trade in India, which are the dollar, euro, pound, yen, and obviously the rupee. So when we talk about derivatives as such, do you know what are the volumes of different asset classes over the in derivatives across the world? On your left hand side, the chart which shows is something what is the volumes pyramid of different asset classes across the world. So you have debt derivatives, interest rate derivatives as they call it, to be the major volume generator in the derivatives market, followed by the currency, the commodities, and then finally equities. However, it has been observed in India that the pyramid is absolutely inverse. The market participants in India primarily are interested only in dealing with equity derivatives. Now, one of the thought processes even across SEBI and RBI is that this is due to lack of information, lack of know-how, lack of knowledge about the interest rate and currency products. Once people are educated in these products, they are sure that the volumes are going to drastically increase in these products. So having said that, such sessions become all the more important for the reason of achieving this, bridging this disparity rather in the volumes of derivative asset classes. So what we are going to talk or cover today is basically we are going to look at some basics of Forex, because I'm sure you all are all trading in the indexes on the equity F&O product. But you all have not looked at CDS as a segment which needs to be looked at so that you can make some money. So we're going to typically look at some of the basics in Forex, which will form the building blocks of what we're going to discuss after that. We're going to discuss some opportunities for both traders that are retail individual traders as well as on the corporate side. Then we are going to talk about some risk management techniques. And finally, we're going to talk about some outlook on the dollar rupee side. So let's start with some basics of Forex. Spot market, Forex market is traded in spot. I will come to what spot is, but what it does is we always trade in currency pairs. So when you say that I bought Reliance share or SBI share or Nifty or Bank Nifty or any other index, what you are essentially doing is you're buying an asset and paying your currency. So everything, because it has a common denominator, which is rupees, There is no need of saying that it's a pair. However, when we talk about currencies, it's always in a pair. So if you are doing a trade in USD INR, if you're buying USD INR, what you're essentially doing is you're buying USD, but simultaneously selling INR. Similarly, if you're selling Euro USD, what you are doing is you're selling euros and buying USD. Simultaneous trades happening on both the fronts. It is a very important concept that you need to understand, because that is how the derivation of other currencies will happen. I will just come to that in a minute. Then the next concept that needs to be understood is which one is my base currency and which one is my quoted currency. So when we talk about USD INR, always USD is going to be your base currency and INR will be your quoted currency or quotation currency. What this simply means is, when I say what is the value of USD INR, I am quoting the value of 1 USD in terms of INR. So how much does 1 USD cost in INR terms is the base currency quotation currency concept. Why is that important? Because you don't have multiple currency pairs trading in the market. So you don't have a direct quote for a Vietnamese dong INR. What you're going to have is a USD VND rate and a USD INR rate. USD being the vehicle currency between. Now, if there are 200 countries, 200 currencies, and each of them have to be paired with the other 199, the list of pairing is going to be crazy. To avoid that, what they have done is they've worked out, the world leaders together have decided that we are going to use USD as a vehicle currency. Each currency is quoted in terms of USD, and then the derivation happens. So there are 4 currencies in the world which are quoted directly. So whenever you say euro or cable, so it is always a euro USD trade. It is never a USD euro trade. So euro USD is a direct quote. So the base currency in terms of euro becomes euro. Euro USD, the base currency is euro. Similarly for GBP, for Australian dollar and for New Zealand dollar. So euro, cable, Aussie and Kiwi, these are the only 4 currencies where you have direct quotes. These are quoted as base currency in terms of dollars. For everything else is quoted in dollar terms, dollar yen, dollar dong, dollar real, dollar ruble, dollar rupee. Right? So let us look at some examples. Now, if I tell you that euro is at 1.0950 and INR is at 83.20, basically what I'm trying to tell you is that euro USD, because euro is the base currency out there, so euro USD is equal to 1.0950 and USD INR is equal to 83.20. Can you quickly calculate what is euro INR? You all can put it in the chat if you want. Okay, so basically euro INR would be just the multiplication of the two, 1.0950 into 83.20, which works out to be 91.1040. Similarly, if I ask you for GBP is 1.2655 and euro is 1.0950. Now, can you calculate euro GBP? This is not going to be a direct multiple. Here again, what I'm saying is GBP USD is 1.2655 and Euro USD is 1.0950. So Euro GBP would be nothing but 1.0950 divided by 1.2655. Understood? So that is why the concept of base currency and quotation currency is very important, because you will have to eventually derive the value of that currency for yourself. So 1.0950 divided by 1.2655 works out to be 0.8653. And the last example I'm going to ask you now, I want some people to answer this in the chat, please. JPY is quoted at 1.4345 and INR is quoted at 83.20. What would be JPY INR? You can even just put this divide by this. I'm okay with that. You don't have to calculate on Excel. Which one would be your numerator and which one will be your denominator? Okay, that is wrong, Kushagra. What I am doing, I'll explain why. The reason why I asked was a trick. There is a little this thing in that. No, that is not the answer, Alok. And that is what a lot of people make a mistake. Here, what we need to do is we need to divide 83.2 divided by 1.43545. And I believe somebody has written that. Arvind has written that. And yes, Kushagra, you're right. The reciprocal is correct. So the reason why you have to understand is JPY. When I say JPY is 143.45, what it means is USD JPY is 143.45, not JPY USD. And because it is an indirect currency, the denominator is yen out there. It's USD divided by JPY. So when I ask you JPY divided by INR, what you need to do is you need to do a USD INR divided by USD JPY. And that's how you get JPY INR. And the correct answer then obviously becomes 0.58 approximately. So it is very, very important for us to understand which one is base currency and which one is quoted currency, which brings us to the next concept of understanding how the forward market works. So if you have a date line where today T plus 0 is called cash. It is value dated cash. In the same way, tomorrow T plus 1 is value dated Tom. 5 years call off give you a free hand to start trading on it. In the same interest rate differential. It is based on a no arbitrage principle. And that in India is 6%. Your currency, that is USD INR, should move up by at least 4% so that efficient. Okay, at 91.25. Now euro, the interest 4.5, the premium in euro is higher than that in dollar. Right? Simple concept. Let's move ahead. Money loves arbitrage. If I can, there are opportunities which you can take even as retailers. The first one being future intercurrency arbitrage. What I mean to say by that is, if GBP INR is trading at 105 rupees 10 paise, at 105, then there is a clear arbitrage. You can directly go and sell GBP INR at 105 rupees 10 paise and buy GBP USD and USD INR from the market, and the three trades together form a completely hedged triangle where there is zero risk and you have made a clean 10 paise. It is difficult to spot 10 paise arbitrage, but 2 to 3 paise arbitrage are available on so many days in the market. If you concentrate and if you try and keep looking at these currencies, you can easily capture these 2 to 3% arbitrages, which are 2 to 3 paisa arbitrages, which are lying on the table to take. Now, there are arbitrages between futures and options. For example, if you have an in-the-money option, I hope everyone understands options out here, because in the interest of time, I cannot go in and explain the entire concept of options, but I'm going ahead with the assumptions that options are known to people, at least in the equity segment, you all are trading in options. So when we talk about futures and options, there are in the money options, which are primarily in their payoff chart equal and identical to a futures payoff. Now, if that be true, if I see a mispricing between the in the money option and and a future, I can easily take an arbitrage between the two. I can, if the option is lower price and the future is higher price, I can buy option and sell the future. And there are such opportunities every day, because there are so many multiple options, so many strike prices given in currencies. Also, there are so many different maturities. which brings us to the next opportunity, which is market making opportunities. Because of so many strike prices and so many maturities, not each one of them is liquid. So if you find an illiquid security, say a 3-month transaction, which is 50 paise or 75 paise higher than the current market price or lower than the current market price, you can go and give liquidity to that contract. You can make markets, give a bid and offer 10 paise wide. And if somebody hits you there, you can easily take a hedged position on any of the other securities which are much more liquid. So with a completely hedged position, you can make markets and earn a good amount of arbitrage. And these opportunities are there every single day. Trust me, it is available for you to take. Now, this is about arbitrage, which is just free money. Let's start looking at more positional setups. So there are various strategies that you can adopt, and the most popular strategy, gamma scalping, is a very, very low profit strategy, which mostly institutional desks do, because that is also another kind of arbitrage, because it's very, very low risk. But the returns also are very low. But otherwise, the other ones are all positional strategies, depending on your views, whether you feel. So, for example, the volatility is crunched these days in the dollar rupee. People say, "Itna kam paise mein, 3 paise mein kya trade karne ka?" But why can't you just do a long strangle out there, or a long straddle even? The volumes, the volatilities are so low, the implied vols are so low that the premiums have also reduced drastically. If you do a long straddle, and if this is the month that the market moves, you are definitely going to make a handsome money on either side. But what if the market doesn't move? Now that is a risk that you need to take. It's not, nothing is risk free when you do a positional setup. But having said that, your risk is very, very limited. So you know on day one that this is my maximum risk and what is my maximum profit potential, and that's how you go ahead and create a nice straddle out there. And these are the ways you can first understand which option strategy is favorable to your view and start applying that. Let's try and understand why I'm saying you should look at equities you should look at currencies at all. You are already trading in equity. There are some advantages of Forex over equities. It is a mean reverting asset class. What I mean to say by that is that typically you would see that over the last 20-25 year horizon, dollar rupee has gone up by approximately 3% every year. Around that 3% straight line of depreciation, the market has moved like this, like this, like this, but it is always reverted to that 3% depreciation line. That 3% was also defined by the difference between the two interest rates of the two countries, but it was adjusted for the purchasing power parity. In the same way, in today's context, because we are only at 1% interest rate differential and purchasing parity wise, if you adjust it, you'll probably see a 0.75% depreciation on the mean of your line this year. Now, having been able to calculate this amount theoretically, you will see that eventually the market will touch that number sooner or later in its life. And that is why you have a surety in mind, a comfort in mind that that number is coming. And if you know that that number is coming, you can have a calculated look or calculated approach towards your trading. There is a direct involvement of government as well as central bank where currencies are concerned, because currency moving up affects everything in the country. And that is why you are seeing RBI, which is controlling the volatility so beautifully these days. And they have been telling multiple times in their monetary policy that our job is to control the volatility, and they are being very successful in doing that. In the long run, the theoretical trajectory will always be followed in currencies. And because of the depth of the currencies, it is not easily manipulatable. So it is, I would request you to at least have a look at currencies so that you can find another asset class to start trading into. Now, let's look at some opportunities for corporates. Uh, corporates mainly can use currency futures and options for hedging purposes. Why use futures and options when there is a forward market? Because there is a clean, transparent pricing on the exchanges. You can have a very, very transparent price for February or March or even an April contract. You can get a 2 paisa spread on the exchange, which is very, very difficult to get when you go to the bank directly. Um, there is no documentation required, and sometimes what happens is when you book forward contracts, the bank takes a lot of document charges from you. Sometimes I have seen that going up to even 3 to 5,000 rupees per contract, and that being said is a huge cost for hedging. So in the exchanges you don't have to pay that. Also, when you use options, you can create very low cost structures. There are small lot sizes, there are multiple strikes and multiple expiries. So depending on your payable and receivable, when is the money coming in or when is the money going out, how much is the money coming in or going out, you can choose how to hedge. Now, it is an off balance sheet item. It does not affect the balance sheet directly, and you can take leverage positions. So the margin required for trading in currency futures is just around 2%. So it's a 50-time leverage product. It's a huge advantage for anybody who wants to get into the trading of this. Now, see, it's important to understand my downsides as well. It's very easy to say that, okay, you trade in currencies, you'll make money, it'll always come back to its mean levels, and the trajectory is theoretical and stuff like that. But you have to have some robust risk management techniques, and without that you will eventually make losses, and you'll start blaming the asset class. Nahi, mere ko ye asset class mein acha nahi lagta hai. But that's not really the case. The case was the risk management was not very robust. So before we get into anything, let's look at some risk management techniques that we should follow. And this is not just for currencies, it's for everything that you trade. Always, always, always have a trading plan. Before you take a trade, you should know this is the amount that I want to make in this trade. So this is my profit level. This is my stop loss level. I will not make a loss more than this. What is the objective of my trade? How much is the position size? You should have an entire plan ready before you enter. If it goes up, what will I do? How will I trail my stop losses? That entire plan should be already made. Then only enter a trade. Before entering into the trade, have your payoff charts. When we're talking about options, because it's not a linear product, you should always make your payoff charts. So these are some payoff charts which I have put on your screen. A long call, long put. These are the basic. The one on the left side are the basic payoff charts. And when you combine them with different options, you get the payoff charts which are on the right side. Your butterflies, your short calls, your iron condors, they look something like this. How these things have come, you can easily Google. It's all available online. If you want, we can do another session on options specifically. But what I'm trying to say is you should always have a payoff chart. You should know before taking a trade how much you stand to gain if the market goes to an X level, or how much you stand to lose if the market goes against you. So that number should always be with you. Stop losses are a must. I need to know where I am getting out before I get in. Without that, people who do not use stop losses eventually stop trading, because the losses extend so much that you will end up losing your capital, and losing your capital means losing your trading ability. See, you can't make money when you don't take a bet. And you can't take a bet when you don't have capital to take that bet. So don't lose all your chips in one go. it is very important to decide how much position to take. It is, the lot sizes are available, how much lots, but how many multiples of that lot size do I want to hit? Hitting one lot in a dollar rupee will not really make you much money, but hitting 1 million thousand lots, $1 million will probably, in case your stop loss gets hit, will lose more than you were wanting to lose. So the idea is that you need to size your position. So if you have an X amount of capital, you need to decide only 10% of that can I lose in one single trade. So you take a trade only based on that much risk attached to it. And if the stop loss is hit, be disciplined to take a loss. At any point in time, you want to be a disciplined trader like the person who's on the left, calm, composed, looking at your levels, taking action whenever required. You don't want to be like the person on the right who is taking emotional calls. There is greed which happens when market is going in your favor. There is fear which happens when it is going against it. Both the cases are very, very dangerous. There is no scope of emotions in the market. So that brings us to the last part of our presentation, which is an outlook on the currency. We are only going to look at dollar rupee today. What happens is there are a lot of factors which happen in the market, a lot of things which are like known unknowns. For example, there is a war which is going on in Ukraine. There's a war which is going on in Israel, Hamas. There is a trade route which is being hampered in the Red Sea. These are all known unknowns. You don't know where they will end, but there is some problem going on. We all know that. There are COVID cases increasing. We all understand that. And there would be some unknown unknowns which will happen, which we can't even think of right now. What is going to happen then? So all of these things put together create a lot of uncertainty in the market. So whatever we are talking or discussing today are about what is already there in the market. The knowns we are going to talk about. The unknowns, we can leave it for another time, and we can always change our views based on any unknown coming to light. So the first thing that I want to talk about is what the RBI presented in the monetary policy, which happened in December. We are going ahead with a very robust, sustainable growth. We have already clocked 7.5% this quarter, which is higher than any other, high GDP country. So we are going at a very good run rate, and we are expected to continue to maintain it for the foreseeable future. Now that is a very good comfort. In fact, in the IMF review also, it has been told that India is the knight in shining armor in the entire world, and the GDP of the world is being led by India. About 16% contribution is happening from India, and which is a very good number to have. Inflation has come under control. We saw a very high inflation period in 2022. And that has come under control and is expected to be in the range of RBI's target. And as per the fan chart which the RBI has given, it's going to be between that 2% to 6% band in the foreseeable future. So there is a lot of comfort from the growth and the inflation side. If you see the trade data, the trade deficit is definitely reducing. We are exporting more, we are importing less. Services exports are growing up, merchandise exports are growing up. Atmanirbhar Bharat is working, imports are reducing. We are substituting things which we used to import earlier from by things which are made in India, and this is reducing our trade balance outgo. Last November, we had a shortfall of $10.5 billion, which has reduced to only $5 billion. You can understand how much comfort that gives to the government when that much money is being retained within India. The forex reserves is on the rise. Now, if the forex reserves, weekly forex reserves are going up by $3 to $4 billion, so every month you are seeing almost $12 billion the forex reserve are increasing. And if that continuously happens, you have a lot of war chest to start protecting your currency movements on either side, which RBI is doing really well. They use this for war chest when the entire global market was in a turmoil, and very effectively curtailed the depreciation. And in the same way, they are also curtailing the appreciation of the rupee. So there is a very handsome war chest that we have, and that gives us the comfort that we are not going to have a runoff depreciation in the rupee. The next chart that I want to show you is a very interesting one. We are in an election year next year, 2024. What happened in 2028, that's like the beginning of the chart. Then 2013, 2008, 2013, 2018. Each of these years saw a sharp depreciation in the rupee. And immediately the few months after this depreciation and before the elections saw a sharp appreciation as well. So if you go by the principle of history is likely to repeat itself, you are going to see some amount of appreciation coming in from the from today till the elections come. So our visibility right now is till the May of 2024, and we are expecting some appreciation to come in. The other outlier was the COVID March 2020 number, where again it had hit. But if you see this thing, this is a chart which is moving from 2010 or even before that, 2008 or 9 till today. And we are what we are seeing is that dollar rupee very comfortably is moving in this channel, which is that what I was talking to you about, that trajectory of 3% depreciation per annum. It goes up, it comes down, but it remains within this price band. So what we are expecting it is that this where it is today, if you can see my cursor, from here it should move downwards towards here and touch the lower end of this band somewhere in May, and then start moving up again. So that would be somewhere around that 80 level is what we are looking at. I know it's a long way from here right now, and with the way RBI is intervening and not letting it appreciate, it's a long shot, but that's what the charts are telling us for now. What we have to look at is something called how much depreciation should be there. What is the theoretical value of my rupee today in terms of this depreciation? We've drawn a chart from 2016 to 2023. The interest rate differentials are the bars in that. We had an interest rate differential of roughly around 3 to 4% between US and India in this entire period, and an average depreciation of around 2.8 to 3% in the same period. This difference is due to that purchasing power parity calculation that I told you. And that is the depreciation that we expect it to maintain. Last year, we've seen a runoff depreciation in 2022, and we expect that there would be some amount of appreciation so that that balancing of that number will happen in this year. Crude oil, which is one of our most important outgo of dollars, is systematically coming down. This movement upwards is this movement upwards is due to this supply block which has happened in the Red Sea, but it was coming down very systematically, and now that supply shock has come in, you see this, but sooner or later that is bound to be taken care of, and crude oil is in this downward trajectory. So that is another comfort to USD INR, so to say. So coming to our last chart, when from August you had a runoff depreciation in the dollar index from 100 level to 107 levels, we participated in that from somewhere around 8150 all the way to 8350. And when that reverse happened from 107 to 102, because of RBI collecting the dollar reserves, we have not participated in that pullback rally, whereas a lot of other emerging markets and developed markets have appreciated against the dollar, which is why rupee has depreciated much more against the euro, against the pound, or even against the Chinese yuan as compared to the dollar rupee. So when we look at it, we usually look at only the dollar rupee factor, but the depreciation of the rupee against the other currencies have been much sharper, and we expect that to appreciate. So while INR, I'm just going to read out what's there on the left. While INR participated to a large extent in the up move of the DXY, there was little participation in the down move. This led to a sharp depreciation of the rupee against other currencies, and a correction to that effect is due. So we see USD INR moving below 82 from here. And if there is an overextension of that rally, it may even test 80 once before May of 2024. So with that, we can take questions. I am done from my side. Thank you very much.
Sure, sir. Thank you for the presentation. It was really nice. You have covered all the concepts like what is the rupee dollar outlook and about the risk measurement which these clients or the newbies should take care of. So we have a question in the chat box. Sanjeevi Narsimhan from YouTube and Alok Kumar on Zoom has asked same question that if they are newbie, how should they start currency trading?
Oh, it's exactly how you would start a nifty trade. First of all, register in the CDS segment of the exchange, and then take one single trade on either side. You feel dollar is going to go up, buy dollar. If you think it's going to come down, sell dollar in the future segment. Do that. Everything else you will start reading up, and you will start doing everything for yourself. And really, $1 or even one lot, or even 10 lots will not really make a lot of money, nor you will lose a lot of money. But that's the cost of trading, and I'm sure you are going to learn from there. And self-learning, or for a trader, what works for me cannot work for you. It is no one sock fits all. So take that first trade, do that, and then start learning from there. Your learning curve is always a J curve in trading. It's never a linear curve. The first loss that you book, you're gonna sharply learn a lot from that. So just keep that first loss very, very minimal, and you're going to do well.
So the point is start small, but start. You should start. So the chat box is buzzing with questions. So here comes another question. Why should I hedge? When I'm hedging the capital, should I use the stop loss? Is it mandatory?
Okay, so when it's a hedge, we don't talk about profits or loss. A hedge is a hedge, and that's exactly what it is. I have a payable. I don't want to take any risk that when that payable time comes, what will be dollar rupee, or for that matter, euro rupee, whatever my payable currency is. So because I don't want to take a risk, I buy today itself, and I block the rate today itself. Now, whether it goes up or down, how do I make any profit or loss? A stop loss concept will only come when you're open to either profit or loss. So please look at hedging as a pure hedge concept. Don't look at okay, I've hedged. Now it has gone in my favor by 2 rupees. Let me unhedge. Then again, I'll hedge again after some time. What if it goes further 5 rupees from there? You don't know the market. So when you're hedging, it has to be hedging only. And when it is about trading, then you do your position sizing, you make your trading plan and trade accordingly. And you should have a stop loss while trading for sure.
Thank you, sir. So there's a question for ICICI Direct Trading Platform. Mr. Vikas, I'll tell you that in next 5 minutes. Till then, can we take this question, sir? Do you want us to sell USDNR when it hits high?
What is your favorite USDNR option selling strategy with hedging? Okay. So see, when you say that what I want you to do you want us? No, I don't want you to do anything. Frankly, whatever you wish to do, It is your call entirely. The reason why we are doing this is to educate you so that you can start looking at this asset class. You develop your own trading strategy and do as per what your trading views guide you. It cannot be one strategy fits all. If you ask me what I would probably do when it is going up, I would probably buy a put at this moment, because the walls are so implied walls are so low that even if I buy a put for 3 months, I am not really paying too much time value. And if it goes in my favor in that 3 months time, I stand to make a long haul. So my total loss and my total potential profit, the risk reward is a very favorable situation at this moment. But that is something that is a favorite strategy today. Now, if you talk about option selling strategy, then yes, you can uh, option selling strategy with hedging. So then you can easily do a iron condor or butterfly. They are completely hedge strategies on both sides. And butterfly is a very good hedge strategy on the currency, and you can tweak your strike prices on either side based on your view. If you feel that it is going to go up, you sell a little higher call and buy a little lower call, so you stand to make a larger profit on the upside. But with the puts, don't do that. And if your view is on the other side, then do the tweaking on the put strikes and don't do that on the call strikes. So you can play a little with the strikes, but it is a fully hedged strategy for the selling part of it, the butterflies.
So now I'll share my screen, sir. Could you please unshare your screen?
Yes, I'll stop sharing. Yeah.
Thank you, sir. So I'll be sharing my screen and show you how to trade on ICICI Direct if you want to start trading currency derivatives. Firstly, you have to open a Demat account with the ICICI Direct. If you don't have one, please open one. And simply you have to go on the currency segment. You can place your orders, and if you are a newbie, you don't know anything about it, how to begin, how to start, you get trading ideas from us. So, first of all, even if you are a non customer, you can visit ICICI Direct website, go on currency. You have a brokerage calculator here, so you can calculate, see, for futures and options both. If you are planning for buying any currency pair, you have the buy price, you have the sell price, and put in the lots. You will get to know what is the break even point, what is the tick which you need to get the break even, what is the profit loss you will make, and what are the charges which you will have to pay. So you will get whole view of the charges and expenses which you will have to bear. So you can, this is the brokerage calculator. You need not to be a ICICI Direct customer to visit this page. Second, open a Demat account with ICICI Direct and start trading currency. Here, you can use this smart just a minute, I'll sign in. If you want to know what is the brokerage charge which you will have to pay, or you want to know if you are planning a trading account. So this is the currency. Go on the smart tools, go on the margin calculator, put in the value. If you want to buy futures, say USD INR futures you want to buy, you know the expiry date, and put in the lot size, how many lots you want, what's the price which you want to buy or sell, and you will get the margin amount which you have to pay. See, margin requirement in currency is very low. It is 2.5 to 5% only. Sir has already explained that in the presentation. And if you want to create any strategy, if you have any strategy in your mind, you want to sell something, or you have buy position, long position in futures, and you want to sell another contract. Say you have taken options USD and want to sell it, you can again calculate what is the strategy benefit you will be getting. So if you are creating a strategy, you will have to pay less margin because it's a strategy, not naked position. You will have to pay less you can calculate your strategy benefit from here. Coming to the specifics of the product. So unit size for all the currency pairs, whether it is USD NR, Euro NR, GBP NR, or GPY NR, we have four currency pairs on which you can trade. For all these four pairs, you can just see the lot size here. Unit of trading is the lot size. Okay, it's 1000 USD. For one lot, you have 1000 quantity for USD NR, Euro NR, and GBP NR. This is the case for both futures and options. Quotation is given in INR for 1 USD or that respective currency. Tick size is 0.25 or 0.25 paisa, that is 0.0025. And recently for USD NR, there are a few more strike prices introduced. It is 0.00125. Okay, it is in rupees. Trading hours, someone has asked in the chat what is the trading hours. So you can trade in currencies from Monday to Friday, from 9 a.m. in the morning till 5 p.m. in the evening. This is the trading hours. It's not 9:15, it's 9 a.m. to 5 p.m. Contract trading cycles for you can get contracts for next 12 months, futures and options. Get confused. Slide. It says you have weekly expiry contracts for currency which expires on Fridays. So all these yellow highlighted cells, these dates are these are highlighting the weekly expiry of the contracts of currency. And the monthly contract, it won't expire on the 28th, that is the last Friday of the month, but 2 days prior to the last working day. So 2 days, 2 working days prior to the last day of the month. Here, in this case, 31, 31st is the last working day. 2 days prior to it means 2 working days prior to it means 31st and 28th. So your monthly contract will expire on 27th, not 28th. People always get confused when this contract expires. They generally consider 28th, that is the last Friday, to be the expiry of the monthly contract, but that's not the case. So we have explained you to the this contract specifications. This is for options. One point to be noted here that your on the day of expiry, your contract is settled at 12:30 in the noon, and RBI reference rate is considered as the settlement price, and your position gets squared off. If not by you, then system will square off your position. But the settlement of the expiry happens at 12:30 on the expiry day. You can't trade till 5 p.m. for that contract on the expiry day. Margin requirement is very low when it comes to currency. It's somewhere around 2.5 to 5%. Here we have one more feature known as shares as margin. So if you have demat shares in your demat and you don't have cash, you can use your shares. You can pledge them, create some limit, allocate it to currency and start trading. And you can use 100% shares as margin for trading. For intraday, you won't be charged any interest. It's zero if you are taking intraday trades. But if it's a positional trade, there will be a charge of interest charge of 0.025% per day for the limits which you have utilized. Brokerage and cost. So at ICICI Direct, you pay only 20 rupees per order. For it is per order, 20 rupees per order, not lot. So the doesn't matter what is the lot size which you are trading, what is the quantity or amount which you are using for trade. It's only just 20 rupee per order. And there's no CTT, no STT for this case, so the charges are very low. GST is 18%, exchange turnover and SEBI turnover charges will be implied, but overall the cost is very less if you compare it with equity FNO. So at ICICI Direct, if you are a newbie, you don't have much idea, you can go on iClick to gain, where we provide daily recommendations. I'll show you that. For daily, you have some calls you can go and check if you want to trade, if you want to take a trade. We have a success rate of around 70%. Here, this is I click to gain page. You can look for futures, options, and here we have JPY. This call was given on 21st December 11:15. So these are intraday trades. If you want to look for the research recommendations, you can visit this page. And second is we also provide daily what research reports, which for which you can visit our, even on the non logged in section, you can visit on currency page and view our reports. That is the daily and weekly reports are also published there. There are yearly reports outlook which you can visit. So you have to go on commodity, visit on products page, or you can go on currency and visit the product page. You will find a link for daily report. You get, you will find the daily research recommendations. So here for today it was GBP sell. So you can find other details as well. We have news and developments, what's going on in the currency, strategy follow up, rupee outlook, and so forth. Okay, we have one Telegram channel also. You can scan this QR code and get added in this Telegram group. We do share here morning reports and weekly reports for currency as well as commodities. You can join us on this Telegram group. That's all from my side. So there's one more question in the chat if you would like to take it. It
Which
says
one?
globally currency derivatives large and can't be manipulated, but that is not true for USD INR, as more than 90% volume is from one entity, the central bank.
Okay. No, that's not entirely true. 90% of the volume is not by one entity. But having said that, even if the central bank is so actively so active in the market, the central bank very clearly is upfront telling you what their intentions are. They are not doing anything against what they have already declared in their policies. So you already know what is the largest player's direction. And if you know that, then I think it's only about aligning yourself with that direction and making that money. I hope I
Okay,
answered
sir.
that. The timings, as Beauty has already said, I think somebody has just asked about the timings again. It starts at 9 o'clock in the
Like,
morning and goes up to 5 p.m. So it's 9 to 5 kind of a market. And on the expiry day, it expires at 12:30. Please always remember that, because sometimes what happens is everyone's used to expiry happening at the end of the market. But in cases of currency, it just stops at 12:30. So you will not be able to trade in that on the expiry day.
thank you, sir. I don't think we have more questions now. You have answered almost all the questions. Thank you, sir. Thank you for giving your time for this session.
Thank you very much. Thank you for all the participants for spending your evening with us. Thank you very much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.